Hi, Lindsay. For my accounting project, I'm going to be talking about depreciation, what it is, why we calculate it, and then I'll show you an example of how to calculate it using the three methods of depreciation. I hope you enjoy. Now, what is depreciation? Well, depreciation is the allocation of a plant asset's cost that has been spread out over its useful life. So, for example, let's say you own a coffee shop and your equipment it's brand new. You just opened. The espresso machine you bought cost you $15,000. When you bought the espresso machine, the company told you that the average useful life is 10 years or about 100,000 drinks, with a residual value or a salvage value of $3,000. Now, you've been in business for about 7 years. Knowing that your equipment has about 3 years of useful life, you realize you need to determine the total depreciation on your equipment. Why do we calculate depreciation? Well, depreciation follows the matching principle, and the matching principle is accepted under GAAP. Now, GAAP stands for Generally Accepted Accounting Principles, and following the matching principle ensures that the costs are matched against the revenues of that period. Now, the three methods of depreciation are straight line, double declining, and units of production. Now, all three of these can be used to calculate the depreciation on the value of your plant asset. And the first one we're going to look at is called the straight line method. So, to use the straight line method to calculate our depreciation, we are going to take our cost, so $15,000, minus the residual value of $3,000. And then that's going to give us $12,000, okay? We will take the $12,000 and divide it by 10. 10 is the useful life in years. That will give us an annual depreciation of $1,200. Now, 1,200 is going to be multiplied by the current year, which is 7. So, 1,200 times 7 is 8,400. Then we take the 12,000 and subtract out the 8,400, which will give us a remaining value of 3,600, or 3 years. The next method is called the units of production method. Now, to do this, we're going to take the cost of $15,000 and subtract out our residual value, $3,000, which is going to give us $12,000. Then we're going to divide the $12,000 by the units of production, which in this case is the 100,000 drinks. So 12,000 divided by 100,000 is 12 cents per drink, or 10,000 drinks per year. Now, we will take the 12 cents per drink and multiply it by the current year usage, and that's going to be 70,000. Now, that's going to give us 8,400. So the 12,000 minus the 8,400 gives us 3,600, or 30,000 drinks. The third method of calculating depreciation is called the double declining method. The formula for the double declining method is cost minus accumulated depreciation times 2 times 1 divided by the useful life. So in this case, our cost is the $12,000 because we've already taken out the residual value of $3,000. Now, our useful life is going to be 10. So we're going to take the 1 divided by 10 gives us 1. So our cost, $12,000 times 2 times 1. This is what it should look like if you're using the double declining method. So we have our cost minus our accumulated depreciation times 2 times the useful life divided by 1. Now, before you can times the cost by 2, you need to find out what the useful life is divided by 1, because this follows the order of PEMDAS in math, which states that you have to do the equation that is in the parentheses first. There you go. Now you know how to calculate depreciation for your equipment using all three methods. Depreciation can be used to decrease the value of other tangible assets like company vehicles, buildings, or other machinery. However, you cannot depreciate the value of an intangible asset. And an intangible asset is something like a copyright or a patent, something that you can't hold. And you can't depreciate the value on those because you can't nuggle with them. Thanks for watching.